All right, we've come to the third component of our three model approach to trading the markets and a method that works well during volatile markets. In this video, we're going to discuss numbers trading. Hi, this is Load with Black Bear Dog Trading, and as always, welcome. I'm glad you're here. So, what is numbers trading exactly? Well, it's not what you think. It is nothing to do with learning to apply a slew of very sophisticated mathematical formulas. While there is some math involved, the math is very simple, very easy. What it is all about is decoding the rhythm of the market through applying modular logic. And that is done by analyzing past data. You heard that correctly, past data. By analyzing past data, you have 100% uh, insight in what the market has been doing up to the last really closed bar. So the current bar, which is still bobbing up and down, we don't take under consideration at all because it doesn't really give us any information, real information, until the bar is actually closed. So that's what trading by the numbers does. It gives us structure and it takes all our emotions and gut feelings and whatever else you have that is non structure out of the equation, making for a much more grounded approach. And it gives us discipline and clarity and resilience because, and by the way, this is how you win because you trade consistently, calmly, and with a purpose because you know exactly what is going to happen based on the numbers, on statistics, on closed bars, on past information, past data. So, again, you don't need complex math. All you need is clear logic. However, there is a catch, and the catch is when you trade by the numbers, you're not chasing every flicker of price. What I mean with that is right now, many retail traders look at live data. Live data is candles that haven't been closed yet, bars that are still open. And that 1 minute they're up a few pips, then they're back down a few pips, then they're totally up, then they're totally down, then they stay flat, don't move at all. And you don't do that with numbers trading. Numbers trading is literally statistical trading, or the term that you now hear a lot is called quantitative trading or quant, and that is exactly what it is used for, to analyze where the market has been over a certain period of time. And based on that data, decisions are then made whether or not it is a good time to enter. And if so, should it be long, short, and where should your stop loss be, and those kinds of considerations. So you're really not waiting blindly. You're just waiting and watching with a purpose until such time that the market gives you the answer that you need. By combining these three into one trading method, which is the way you really should be trading, you can trade them separately. You can trade just dynamic, you can trade just flow, and you can trade just numbers. But by combining the three, you now have a system that is second to none. There is one requirement for this system to really work, and that is you must be disciplined. And with discipline, I mean two things. One, you have to execute the strategy the way it is, no changing, no adapting, no modifying, except the way it is, losses and all. And number two, patience, patience, patience. I said it 3 times, and there's a reason for it. This particular way of trading is not on quantities, it is based on quality. What does that mean? That means you're going to get lesser opportunities to trade, but the opportunities you do get are have a much greater probability for success. So it's a trade-off, but I think the trade-off is very good. Instead of doing constantly being in a trade, doing 20 trades, I don't know, a day, a week, whatever, you may be doing 2 trades a week, maybe even only one, maybe none at all. You do one trade in 2 weeks, but the trade you get has an 80 to 90 probability ratio, which means an 80% to 90% chance for being successful. What's more, because you are taking advantage of volatility, momentum, trend, price movement, all combined into one with adaptive stop loss, with adaptive risk management, with adaptive lot size calculation, while at the same time relying on price breakouts that are based on prior price conclusions, and that all together with direction of trend, you have a very solid system, and hence why it works in volatile markets. This is it for today. This video is a little bit complex, but don't worry. Next videos to come, it's going to get much more simplified. And in fact, we're going to go through actual trading strategies using those 3 models. And then once you see it in action, it will definitely become a heck of a lot clearer to you, and you will understand it much, much easier. It's not as complicated as it sounds. Anyway, that is it for now. So I recap. There are 3 models that you should seriously consider trading. It's not fixed trading. Fixed trading I've covered now. It's recipe for disaster. I hate to say it, but it's true because it's fixed. You need to either look at dynamic trading or flow trading, or you need to consider numbers trading. And in the next video, I'm going to tell you how to combine the 3. And after that, we'll do some actual trading with one particular strategy. And like I said, you'll see it in action. All right, this is it for now. Video, keep it short so I don't overwhelm you. As always, thank you for being here. This is Load signing out. Take care of yourself. See you next time. Bye and God bless.